Do you have the money to get started? Have you paid off any and all credit card debt you might have? Most credit card interest rates are around 15 to 20%. In a good year, if you're talking about the S&P 500 index fund, you can make 7 to 10% off of the stock market. This means if you had 20% interest and only made 10% in the stock market, you'd still be losing 10% more than if you'd just taken that extra money and paid off your credit cards. This is why credit card debt will prevent you from making any money in the stock market. You need to be able to have money that has nothing tied to it and no debt. Can you have a mortgage or a student loan or a car loan? Absolutely. But the real devil is the credit card loan debt. That's the one that's going to have an interest rate so high you won't be able to match those returns in the stock market. The second part is, have you maxed out your employer's 401k? If you have an employer that matches any kind of money that you put into the 401k, some match up to 5%, some match up to 7%, your first rule of thumb should be to take any extra money and meet the minimum requirement to get the maximum match from your employer. It's free money. There are a lot of advisors out there who will tell you that putting money into a 401k is a bad idea because the stock market crash is going to take that out. However, we don't know what's going to happen in the future. So you're leaving free money on the table if you're not matching out your 401k. So make sure you match your 401k and then you have the extra money after that. Do you have a long enough time horizon? People say a long-term investor, but do you know what that means to you? Is it 5 years, 10 years, 15 years, 25 years? Whatever money you're putting into an account, you need to not think of it as accessible for whatever your time horizon is. The longer the time horizon, the more you're going to be able to make the proper adjustments to continue making a profit no matter which way the markets go. But if you have a really short time horizon, say you're going to buy a house in a few years or you're going to have a kid, whatever it might be, you might be in a situation where the stock market has dropped a lot and you're going to have to pull your money out at the lows. You want to make sure that you have enough money in an emergency fund on the sideline that you're never going to have to draw down your investments or your retirement accounts. If you're constantly thinking that you have this money in the retirement account that you could use, you're not thinking about it the right way. You have to think in long term. You have to think that that money is going to be occupied for 5, 10, 15 years, whatever your time horizon is. Finally, we're talking about money you have to be able to afford to lose entirely. People say that they're in that right mindset, that they know that they can lose this money entirely. But nothing is going to sting more than when you put your money into an investment and have it drop 20 to 30%. And you have to be able to think of that money as, no, it doesn't matter. It's going to be in there for whatever my time horizon is. So I know that I'm making the right decisions by investing and I can be strong-willed against any of these dips. If it's money you can't afford to lose entirely, then it's money you can't afford to put at risk, at any risk, and you shouldn't be investing it, no matter how safe or reliable the investment might seem. How do you open an account with a stockbroker? Well, fortunately, since the end of 2019, this got a lot easier. A few years ago, a new upstart called Robinhood came out and eliminated commissions. Before Robinhood, commissions were anywhere between $5 to $15. What that means is every time you bought a stock or sold a stock, you'd have to pay whatever that commission charge was. I started trading stocks in 1998, and back then when they first allowed retail investors to get in, it was considered a really low commission when it was $15.95. Back then, if you're paying a $15.95 commission, let's say you're buying one share of a stock XYZ that costs $100 a share. That means after the commission, you're paying $115. Right off the bat, you're down 15% because of the commission charges. So you used to have to think about, how many shares am I buying? Am I sure that the stock is going to go up? Because the commission for small investors was really eating into the amount of money that it was going to be able to make. You were already going to start down. Now, with no commission fees, it means you can go out and buy as little as one share or even a fraction of a share at a time. That means picking a broker is no longer a matter of picking which one has the best commission rates. how are you going to invest? Are you going to sit down and work with the computer and log into a website and make a plan and be able to put in the orders in advance? Or are you the kind of investor that wants to be able to buy on a dip from your phone using a really easy to use app? If you like really easy to use apps, you might be interested in Robinhood or another broker called Webull. Both of them have really good apps that are really great for being able to have a simple interface. Are you going to exclusively invest using the app, or do you also want a broker that grows with you, where you have an app, a website, and then maybe even a desktop platform with a lot of features? If that's the case, you might like a broker like Schwab. They are my personal broker, but full disclosure, I'm not being sponsored by them. They have a great, really robust, feature-filled desktop application that allows you to do charting, that allows really complicated trades, and that's great. But they also have a really simple to use website, and they have a decent app. So they kind of have all of the different facets that you might want to invest or trade. What kind of account do you want? A regular brokerage account gets taxed every year when you sell stock and have a gain. But you can also invest in what's called an individual retirement account, or an IRA. There are two different kinds, Roth and traditional. We'll talk about those later. But there are some brokerages that are so small that they don't offer IRAs. If you're going to want full access to your money, you're probably going to want a broker account. A regular broker account means that you just deposit money into it as if it was a checking account or a savings account, and then you use that money to be able to buy and sell stocks. An important thing to remember about a regular broker account is that you're going to owe taxes on any profits for any sales that you take place each year. So that means capital gains is going to be taken out on an annual basis, and you're going to have to file taxes. If you're a long-term investor, a regular broker account probably isn't the best choice for you. Individual retirement accounts offer you a way to be able to invest in the long term for your retirement, and they both offer different kinds of tax benefits. With a traditional IRA, you don't pay taxes on the money you put in now. That means you can either have the funds taken from your paycheck and not owe taxes on those funds, or if you deposit the funds from your savings or checking account after the fact, you can actually deduct those funds from your taxes at the end of the year. When you are drawing down on the retirement account, you will pay taxes on any of the money that you pull out, including the initial investment. The benefit to a traditional IRA is that the concept is that you're going to be spending more money as you grow older and less money in retirement. That way, if tax rates remain the same, you'll pay less taxes after you retire than if you paid those taxes up front. That brings us to the Roth IRA. Roth IRAs are taxed up front. That means any money that you put into the Roth is already taxed. So even if you make millions of dollars on your investments, once you pull them out when you're retired after age 59 and a half, you don't pay any taxes on both the money that you put in and the gains that you pulled out. A lot of investment advisors will actually suggest the traditional IRA because they make the argument that you'll pay less taxes as you're older because you're not spending as much. Personally, I prefer the Roth IRA because it doesn't assume that the tax rate's going to be the same. For one, I'd actually like to make so much money that I could have a better retirement than I'm living right now, which means I'll be drawing more money than I make right now. But for two, we don't know what the tax rate's going to be. Right now, as this video is being recorded, it's 2021, and the U.S. government just spent trillions of dollars in stimulus. It has to be paid back. What if the tax rate is significantly higher in the 25 years that I have to go before I retire? Suddenly I'll be paying a huge tax bill if I have a traditional IRA, or I won't be paying any tax on that if I have a Roth IRA. For me, the Roth is the better choice. But for you, you should consult an investment advisor and decide whether or not you should go with a traditional IRA or a Roth IRA. Both of them have limitations where you can only deposit $6,000 a year or $500 a month up until age 50, and then from 50 to age 60 you can deposit $7,000 a year. If you make over a certain amount of money, you can't use either of these retirement accounts either. It's somewhere around $120,000, but you have to look it up on the IRS's website because those limits are subject to change on a year-by-year basis. Finally, make sure you really read the fine print. This isn't as risky as it used to be. There used to be maintenance fees, there used to be commission fees, but fortunately, thanks to Robinhood, for the most part, those are gone. That doesn't mean you should sign up without looking closely. Just make sure that whatever broker you're signing up for isn't charging you anything. They shouldn't charge you anything to hold your cash, and they shouldn't charge you anything for trades. There should be no maintenance fees and no commission fees. Finally, once you've opened your account and you're ready to go, transfer funds into the account. Do it from your checking account or your savings account, whichever is easier for you. Most brokerages will allow you to do fund transfers electronically, so you don't have to send a check. You don't have to do a wire transfer. It's really quite easy. You can do your monthly contributions to your IRAs this way. You can do contributions to a regular account this way. They make it as simple as possible to get funds in an account. So now you're good to go. You've got your stock account and you're ready to invest. Next up, what do you invest in? Well, that all determines on your level of risk. How much of a risk taker are you? If you like lower risk, you may find exchange-traded funds, or ETFs, to be really appealing. The lowest risk ETF is either the one that tracks the S&P 500 index fund, an example is Vanguard's VOO, or an ETF that tracks the entire United States stock market. One example of these is Vanguard's VTI fund. The next level of risk, which I would describe as moderate risk, would be ETFs that track specific sectors. For example, dividend appreciating stocks, or big cap stocks, small cap stocks. These have medium risk because you're getting more specific. You're not just tracking the entire index, you're tracking specific parts of the index. And those are also available from a wide variety of resources, including Vanguard. The highest level of risk that you can get into when you're talking about an ETF would be ones that are sector specific. Once again, referring to Vanguard, you can look at their technology fund. Theirs is VGT, and it is a fund made up of tech companies, logically enough. They also have a healthcare fund, which is VHT, a consumer staples fund, which is VDC. There are also other kinds of ETFs that track gold, gold miners, biopharmaceuticals. Not all of these are available from Vanguard, but Vanguard or any other broker will typically allow you to invest in any of them. ETFs track a variety of different companies, which means that if something happens that's positive in any specific company, your ETF will see benefits from it. Additionally, if there's something bad that happens to a specific company, the ETF won't be hurt as much as if you owned the stock of that individual company. Just like holding the shares of individual companies, ETFs also pay dividends based on the weight of any dividend-yielding stock that they might hold in the ETF. All ETFs have management fees. While these fees are built into the price of the ETF's shares, some ETFs have higher fees that can actually eat into your profits. Accordingly, I prefer Vanguard as an ETF provider for the majority of my ETF investing because they have some of the lowest fees across the entire business. While ETFs limit both your upside and your downside, if an individual company that's held in your ETF sees huge upside, such as a buyout or a blowout earnings quarter, the ETF shares will only see a fractional increase of the upside, as opposed to if you were holding the actual shares of that individual company. So you're limiting your upside for those surprise purchases, for those surprise upside moves that an individual stock would yield you. If you've determined that you have more of a risk appetite, then you might want to go out and buy the stocks of individual companies. The pros to this is you have direct exposure to the specific company that offers the full benefit of any successful product or service that comes from that company. You'll see the upside. In addition, some investors really enjoy owning the shares of stocks of companies that they really have pride in, whether it is Apple, Tesla, Boeing. To be able to know that you are a shareholder in the company can offer you a lot of pride that you don't get from if you owned the company in an ETF. Some of the cons to individual stock ownership include being vulnerable to any market-wide weakness, sector-specific weakness, and even individual company weakness, whereas ETFs offer diversification that might protect against sector weakness or individual company weakness. You're going to be exposed. So even if your company is in a sector that's doing really well right now, but it's doing really poorly, despite the fact that the sector will be going up in value, your company's stock will be going down in value. That's the downside risk we were talking about with ETFs. You can be in the sector that's right for the time, but you could still see downside risk if your company makes a mistake. The other major con to being invested into an individual company is that if your company goes out of business, you lose your entire investment. In the case of most ETFs, the chances of every single company in an ETF going bankrupt are very slim. So if you're looking at an ETF like the one that tracks airline stocks, which is called JETS, J-E-T-S, you're not exposed to the individual risk that might come from, let's say, American Airlines going out of business. Whereas if you owned American Airlines stock and they went out of business, you'd lose all your money. Although the JETS ETF would go down if any of the airlines held in it went bankrupt, you wouldn't be exposed to that specific bankrupt side risk because you are diversified across the airlines. All right, so there you have it. Now you've made sure you have the money you need to be able to open the accounts, money that isn't earmarked for anything else. You're maxing out your 401k, you've paid off your credit card debt, you've opened up a brokerage, and you've started thinking about your level of risk, your appetite risk level, and you're ready to invest. This is getting you to that starting point. From here, I'm going to make more videos about how to pick the stocks that work best for you, different kind of strategies that you can use, whether or not you're talking about ETFs or individual stocks. But in the meantime, if you're interested in learning more, check out the website www.getirked.com. It's there that I talk a lot more and have years of content that I've written about these topics. The videos are coming soon, but if you can't wait, that's where you can get started.